So now I'm going to talk about how to fund it. How to fund all this health care that we're going to provide to all the people that have been covered, that are now going to be covered. So as you can tell, this is going to hurt. It already hurts. I mean, we're overwhelmed, overloaded, and overtaxed. So there's the health care part of the Tax Act, and then there's the income tax part of the Tax Act. So there's a lot of fees that Sylvia talked about, but then there's income taxes that are going to be assessed, and additions to Medicare tax that are going to come through your 1040 that you file, your income tax return. So that's the part that I'm going to focus on. And you've heard about the Medicare tax, and there's just to that. And I'm going to go through a couple of calculations so you can see how that works. And, you know, it's not going to affect a whole bunch of people. I mean, there's probably 90% of you in this room it won't even affect. So, you know, first of all, I want to kind of take the scare and the worry out of it, because it really only affects, you know, high income, high investment income people. So it's a very small percentage of people that'll pay, but it gets expensive. So starting this year, we have a measure that we have to go through, and if you're if you're single, the baseline or the threshold is $200,000, and if you're married filing jointly, it's $250,000. So there's a 0.9% additional Medicare tax that will be assessed on employees, wage earners, self-employed people too. It's self-employment income as well, so it's earned income once you get over these thresholds of 200 or 250. And so for a person that's employed, if their salary gets over 200,000, then their employer needs to start assessing and withholding the 0.9% additional Medicare tax on top of the 1.45% that's already withheld. So, you know, if you have a two-earner family and each person makes $180,000, no withholdings are going to happen, but they're going to have to pay some additional tax when they file their return on April 15th. So, you know, there's people that are going to be under withheld. And then there's a 3.8% Medicare tax on net investment income, capital gains, dividends, rents, it's net rental income, royalties, gain on sale of residence after your exclusion, or gain on the sale of a second home, and we'll go through some examples. We also have a new threshold on being able to deduct medical expenses. So up till now, you had to get over 7.5% of adjusted gross income before you got any of your medical expenses benefit from it. So now it's over 10% of adjusted gross income. And adjusted gross income is the number on the bottom of page 1 of your 1040. So it's the total of all your income less some deductions, but it's before your itemized deductions and it's before your personal exemptions. So here's an example of the 3.8%. So you have a retired couple. They have taxable income of $100,000 from their IRAs and other retirement plans, plus pension and Social Security payments of $160. So that's $60. So that's $160. They also have dividends of interest of $40. So that's $200, plus $45,000 from selling some investments. So it's $245. Because all this income totals below $250, the 3.8% does not affect them at all. So on the wages, the 0.9%, we talked about the threshold. So employers are required to withhold an additional 0.9% once they hit $200,000. They don't really have any clue what's happening with their spouse's income, and they don't have to worry about that. So we talked about that. So here's an example of how that works. So John, his salary is $240, and he has hospital insurance is another word for the Medicare tax. He has hospital insurance withholding of $360, which is $40,000 times the 0.9%. And his wife earns $80,000, and there's no withholding from her, of course, because she's under the 200. So they go to prepare their return. They've got $320,000 of income, the exclusion is 250, there's 70,000 that's over times the 0.9%, so their extra Medicare tax is $630, and John had $360 of that withheld, so they're going to owe an extra $270. So, I mean, it's not too terrible. Most people in that bracket could probably write a check for $270. So you can see how it works. It's not the end of the world, but it's more money. So the way the 3.8% works, it's the same threshold, and the tax is assessed on the lesser of net investment income or the modified adjusted gross income over the threshold amount. So net investment income is your investment income reduced by any deductions allocable to that. So usually where that comes into play is rentals. If you have a rental, it's the rent less all the expenses. So if you actually have a loss from your rental, you don't have net investment income from that. And you can be subject to both the 0.9% and the 3.8% if you hit those brackets with the applicable categories. So we have another example. So John's single now. They got divorced. And his salary is $175, and he earns $80,000 from net investment income. So his modified adjusted gross income is $255. The threshold's $200, so the excess is $55,000. But his investment income is $80. So in this case, he pays the tax on the lesser of the 55 or the 80. So it's 55. And so that, in that case, it's $2,090. So that feels a little bit more expensive. And then here's an example where Barry and Michelle sold a non-real estate asset. They sold some stocks and bonds. We have a Barry and Michelle in the room. Oh, Bob and Michelle. Bob and Michelle. So they sold some stocks and bonds, and that generated a capital gain of $120,000. And their other AGI is $140, so they've got $260. And the threshold for a married couple is $250, so the excess is only $10,000 times the 3.8% is $380. So you can see there's a lot of cases where, yeah, it might catch you, but it's not a huge amount of money. So $380, yeah. So capital gains, interest and dividends. So Harry and Sally, they've got substantial income from their securities investments. Their AGI before including that income is $190. Their investment income is listed below. So they've got interest income of $60, dividend income of $75,000, capital gains of $10. So that's $145 plus their other $190. So they have $335,000 of adjusted gross income. And the excess over $250 is $85,000. And so compare the 85 to the 145 of investment income. And so the lesser amount is the 85, and you apply 3.8% to that. So they owe an extra $32.30 that they would not have owed before. And that takes effect this year. So here's an interesting example. So we have Henrietta, and she's single. And her sole income is derived from owning and operating commercial buildings. So she rents, she's a landlord. These assets are treated as business property and not investment income because that's all she does. Her income stream is outlined below. So the gross rents are $750, but the expenses are $520. So the net rent is $230,000, and that's her AGI. And the excess over, because she's single, the threshold's $200, so the excess over that is $30,000. But it's not net investment income. It's business income. So she doesn't owe the 3.8% on net investment income. So it's zero for her. But the twist, there's a twist to that. So because it's her livelihood, then she's subject to the 0.9%. Because that's how she's earning her living, so to speak. So you get one or the other. So that was an interesting twist for me. I would not have expected that because she's considered to be in a trade or business. So if you real estate people out there, if you have a lot of rentals, this could catch you up. So at least it's 0.9%, not 3.8%. So if you have a second home and you sell that, you didn't rent it, so it's not a trade or business, so it's an investment. So the Bridges owned a vacation home. They purchased for $275,000. They never rented it. They sell it for $335,000. So they have a gain of $60,000, and they have earned income of $225,000. So their total AGI is $285,000. The excess over $250,000 is $35,000. Their capital gain is $60,000, so that's more. So they pay on the lesser, so that's $35,000. So 3.8 times 35,000 is 1,330. So I hope you can get a feel for how this is working. So then we'll get into some of the other things that have occurred. There was so we had a tax law that passed on January 1st. So they beat their old record of December 17th and passed a tax law that affected 2012 income tax returns. And there's nothing you could do about it because the year is done. So thank goodness one of those things worked in our benefit. We got an AMT patch. So again, they've patched it and they've made the patch quote unquote permanent. And they've indexed it for inflation. So you can see it's gone up from $78,000 in 2012 to $80,800 in 2013. So hopefully that means there won't be any more waiting till the end of the year to know if we have an AMT patch or not. And it's going to be indexed for inflation, so it will be going up and up as our, as inflation goes up and up. So that's helpful. They put a dollar cap on flexible spending accounts of $2,500. Used to be a little bit higher. The research credit has been extended and extended and extended, and they extended it again, I think through 2013. It's 2012 or 13. I didn't put it in there. So it's not forever, again. There's a 50% bonus depreciation. So that was one of the things they made retroactive to 2012, but we didn't know it until January 1st or 2nd. So you couldn't go out and spend any money to buy equipment to get the 50% bonus in 2012. So if you bought equipment, you get the 50% bonus, and you could still get that this year in 2013. The other thing they extended again is the Section 179 expensing election. And that's if you buy equipment, qualified equipment. Most equipment applies, but not leasehold improvements. So there was like a 2-year bonus there where you could expense some leasehold improvements, but that expired in December of 2012. So again, we have a high expensing limit for purchased fixed assets. And then we talked about the higher threshold for medical expense deduction. So here is the new brackets for 2013, and I just wanted to give you a flavor for it so you can see, like, where do I fit in here? But one of the things, too, was, and this was part of the American Recovery Tax Act that was signed January 2nd. So we went back to having the higher bracket of 39.6%, and so that was in effect back in 2000, and in 2001 with the Bush tax cuts, we eliminated the 39.6, and our top bracket has been 35% for 11 years. So the top bracket doesn't hit people until they are married filing jointly, that once their taxable income is $450,000 or more. And for single people, it's $400,000 or more of tax. That's taxable income, so that's after all your itemized deductions, your standard deduction, your personal exemptions. The standard deduction amount is $9,950. The personal exemption, we've had 2 years of not having that be phased out. So once you hit $150,000 roughly of AGI, your personal exemptions used to be phased out. Then for 2 years they haven't been phased out. The phase out is back. So they will start being phased out once you're over that threshold of AGI. And we have the AMT patch exemption. So what can we do to do some tax planning and be proactive and try and minimize our taxes? So dividends from C Corps and S Corps are still being taxed as capital gains. So So S Corp's a little bit different because if you get a distribution, that's not a dividend. So, but you are able to declare dividends if you're an S Corp. And corporate dividends, you know, whether it's from IBM or your own corporation, those are taxed just like capital gains at 15%. There is a higher, once you get over a certain threshold amount of capital gains, then there's a 20% capital gain that starts kicking in. So if you sell a second home, for example, and you bought it 25 years ago, you might hit that 20% rate. So, but the 15%, and I don't remember the threshold off the top of my head, I apologize. Okay, and so another thing that you want to consider is being able to, like if you do have a big capital gain, you know, you're selling a second home or something like that, make sure and look at your, you know, stock portfolio or your bonds or whatever, and you can harvest any losses that you have in there. Get rid of the emotion and just sell it, for God's sake. And use those losses to offset that capital gain. So, you know, make sure you're planning with your tax preparer and your investment advisor to take advantage of those losses in a year where you have big capital gains. Another thing, too, is, you know, since now, you know, this modified adjusted gross income is a big deal, one way to avoid that is if you do have a Roth, then distributions from the Roth don't go on your tax return, so they don't increase your threshold. So it's a way of potentially keeping your threshold down. So, you know, a lot of us make too much money, we can't put any contributions into a Roth. If your number on the bottom of page 1 is 100,000 or more, you can't make a contribution to a Roth. But what you can do is you can do rollovers from a regular IRA to a Roth IRA. And for some of my clients, I'm going to look at doing that, like, you know, a little bit every year. If they're in their 50s or 60s, it might make sense to do that so that they start getting it into their Roth and it can grow for more than 5 years. It's got to be there before they can take it out without a penalty. So it's something to think about, you know, it might be worthwhile. And there's also a new, or certain employers have put in a Roth 401k. I have a doctor, he makes $450,000 and he's maxing out a Roth 401k. It's a qualified plan, it has to be, you know, an employer plan. I had no idea they existed, but they're brand new last year, so, because I'm going, he said, well, I contributed my Roth. I said, you can't, you make too much money. And he said, it's my employer's plan, and it's a real thing. So I was shocked. There's no limit on that, correct? It's the same limit, you know, it's the 22.5, and you get the catch up if you're over 50, so it's the same amount of money. Yeah. So buying it, you know, if you need to buy equipment, this is a good year to do it. You can still get the high expensing limit. You can still get the 50% bonus. So if you need to buy equipment, it's a good year for that. We talked about the Roths and, you know, how it doesn't affect modified adjusted gross income. So, you know, we've heard about this Affordable Care Act for a long, long time. It got signed, and you'd think we should know something after 3 years, but we don't really. We're just now peeling back the layers. So this is just some interesting stats about who pays taxes. So this is where I say, you know, the top 1%, they're carrying the burden, and there's no question about it. They've received 17% of all income. They paid 37% of all federal taxes, the top 1%. And that's people at $344,000 of AGI, of taxable income, and their average AGI is $960,000. So the bottom 50% on the flip side, their income is under $32,000. Kind of got a feel for those people. They can't get a job. They've received 13% of all income. They paid 2% of all federal taxes. So clearly, the top 1% is carrying the bottom 50%. It's a lot of people. So we kind of talked about that. So there you go. The IRS is shaking us down. That's it.